The Polsky Practical Personal Enrichment Series is underwritten by the Polsky Family Supporting Foundation in partnership with the Johnson County Community College Foundation, which seeks to educate and empower the public in the areas of health, financial independence, and topical issues not covered elsewhere.
Good evening, everyone. Welcome to Johnson County Community College and welcome to the Polsky Theater. My name is Christy McWard. I am Director of Marketing and Event Management here at the college, and we are so pleased to have you here with us for tonight's Polsky Practical Personal Enrichment Series. Tonight's topic is Financial Outlook and Opportunities 2014, Overcoming Obstacles. And we're featuring Certified Financial Planner Tim Carlin, who will be out here with us in just a moment. And he has a presentation full of great facts and figures and excellent data and projections for us for the 2014 economic outlook. He's going to tell us some things to be optimistic about, some things to be cautious about, and regarding strategies and opportunities for long-term investment success. So I hope you're ready, and I bet you've already looked through your packets and you can see that they are full of great information, right? Well, that's thanks to Tim. He put all that together for you. See some familiar faces in the audience too. Thank you to our regular Polsky visitors. For those of you who don't know about the Polsky series, the Polsky Practical Personal Enrichment Series was established in 1997 by the Norman and Elaine Polsky Family Supporting Foundation in partnership with the JCCC Foundation. And the series seeks to educate and empower the public with topics and free lecture series on education, health and wellness, financial stability, and other issues not covered elsewhere. We are very pleased to have the continued support of the Polsky family. They come to many events and they support us very enthusiastically, and I think you guys are out there, right? They're right there in the front row, second tier. Let's give them a big hand for their continued success. Thank you. Before I bring out our speaker, I know you've had a chance to look through your packets, but let me just highlight a few things that are in there. First of all, you have a couple of cards, a green one and a blue one. The green one is very important to us. We hope you'll take a moment to fill it out with your information. We'd love to be able to notify you of upcoming events. We have about 4 Polsky series events a year, and we'd love to be able to tell you about them so that you're the first to know about them. Also on the card, tell us what you'd like to see at a future event. We plan these series events for you. They're free and they're for you, and we want to bring you the topics and speakers you're interested in. So please don't be shy. Let us know what you think, okay? Also, we have the blue cards. The blue cards are special because they're for any questions that you might have, but maybe you don't want to ask outright. Tim is going to leave a lot of time for question and answers after his presentation. It's going to be a big bonus, actually, to tonight's event. So he's going to have a free Q&A with you. You'll be free to ask him questions. But if there's a question maybe you're not comfortable asking or you just don't feel like speaking up, fill out the card with your question, hand it to one of our ushers, and they will get it to me, and I'll try to ask it if we have time, okay? And then one more thing, as I said, we have several Polsky events a year, and you have a flyer in your packet for our March 27th event, which is a really interesting, exciting speaker, Adam Stelzner. He was the lead engineer on the Mars rover project Curiosity, which successfully landed on Mars in August of 2012. So he's going to tell us all about science education, team leadership, management, and his unlikely path toward being an aerospace engineer. He started out being a rock star. So It sounds really interesting. You don't want to miss that. It's in Yardley Hall, by the way, too. We won't be in this room. We will be in Yardley Hall on Thursday, March 27th. Another change for you Polsky regulars. It's going to be on a Thursday night, not a Wednesday night. Okay. One other thing, if you want to stay in touch with the Polsky series and what we're doing, you can always check out our website, www.jccc.edu/Polsky series, and you can also catch videos of previous Polsky series events as well if you happen to miss one along the way. Okay. Let's bring out Tim. You're going to be impressed with Tim Carlin. And you're going to take a few minutes to read his bio to you because it's a very impressive career that he has. Financial advisor and certified planner Tim Carlin is a 22-year veteran of the U.S. Army and Kansas Army National Guard. While on active duty, Tim served in the 101st Airborne Division and the 2nd Armored Cavalry Regiment, both stateside and overseas in Germany and Central America. He is airborne, air assault, and Ranger School qualified. Upon leaving active duty back in 1990, Tim joined the Pepsi-Cola Company and served in various operational and financial roles, leading to Director of Franchise Operations for KFC restaurants in Kansas, Oklahoma, and Northern Texas. Tim later became Director of National Quick Service Operations for the Phillips 66 Petroleum Company, where he helped grow the Kix 66 brand for Phillips 66. Everyone familiar with that? Later, Technomic, a Chicago-based national restaurant consulting firm, hired Tim to help national and independent restaurant brands develop and expand their business operationally and financially nationwide. Since 2005, Tim has been a limited partner with the financial advisory firm of Edward Jones, where he currently manages $100 million in assets for a select group of high net worth individuals and companies throughout the United States. Tim has been named to Kansas City Magazine's Best Wealth Managers list 6 years in a row. Throughout his career, Tim continued his military service in the Kansas Army National Guard. In 2006, he retired as a colonel. He is a graduate of the United States Military Academy at West Point, and he earned his master's degree in international relations from Boston University. He's also a graduate of the Command and General Staff College and of the U.S. Army War College, earning an additional Master's of Strategic Studies. I told you it was impressive, right? Please help me give a warm welcome for Tim Carlin.
Before I get started, Chrissy, can you stay up here for a couple seconds? I want to do a couple thank yous, and I'm honored to be here tonight. I first want to thank the Polsky family and the Polsky Family Foundation for allowing us to put on this presentation tonight. Thank you very much. I'd also like to thank Christy, Barbara, and Stacy for all that they have done, and being a plebe at West Point for a while, I can tell you Christy does a great job of making sure that I have my ducks in a row and my shoes shine. So I have a little something for her. And I want to thank you very much for everything. There you go, making sure I'm on target. Thank you very much. I also want to thank Karen Mitchell. Karen Mitchell was my first assistant, and she surprised me tonight by coming by. Karen, can you stand up? Because the reason I'm here tonight is because of you 11 years ago. Thank you. I also want to thank the Vol Stars. I used to be a Vol Star under Roxanne Hillman and Robert Potty, and they do a great job. And thank you very much, Vol Stars. And before I get started, what I'd like to do is something a little special. If you've served in the Army, can you please stand up? if you've served in the Navy, can you please stand? The Air Force, Coast Guard, the Merchant Marine. Did I miss anything? Let's give them a hand. Now, if you can get back up standing, I've got a little surprise for the oldest grad here. So if you guys can stand back up again, and ladies, again, please. Okay, if you were born after 1980, 1990, have a seat, relax. 1970, and what I mean, maybe I said that wrong. Hang on. If you were born younger than 1980, have a seat. Okay, if you were born younger than 1970, have a seat. If you were born younger than 60, have a seat. 60, okay. 59, have a seat. 55, have a seat. 50, 1950, 1949, 48, 47. Tom, you thought you were going to be around for a lot longer, didn't you? 46, 45, 1944, 1943, 42, 41, 1940, 1939, 1938. You guys look great for your age. Congratulations. 1937, 1936, 1935, 1934, 1933. And you know what kills me? You are the guys who work the steps coming down and back up. I mean, 1932, 1931, 1930, 1929, 1928, 1927, we have a winner. Sir, I'll give you a choice. I have. 1923? Yeah. Wow, congratulations. You look great. Thank you for your service. I have two possible little gifts for you. You tell me which one you want. I have The Cool War, The Future of Global Competition with China by Noah Feldman, very well reviewed. And then I have fresh Kilimanjaro coffee. I just got back from Tanzania. And the book or the coffee? All right, I do that too. We'll give this away later. I do that too. Okay, before I get started with my prepared remarks and then the question and answer session, did everyone see the State of the Union address last night? Pretty much. Okay. I thought it was very interesting because of all the different things going on. One of my buddies was in the audience, a military officer, and he said, you know, before the meeting, all the military brass, you know, the Joint Chiefs of Staff were around. And, you know, during the meeting, they have to sit on their hands with the Supreme Court justices. They can't clap and stand up like the Republicans and Democrats can when there's things being said. If you notice, they just sit on their hands. But prior, he said, man, they were going at it. I said, what were they doing? What were they saying? He said, well, they were talking about who has the most courageous soldiers and sailors and airmen. I said, well, what did they say? What was happening? He said, well, they were all behind, you know, in the antechamber, and they were talking about, you know, the Air Force general said, you know, I told my best fighter pilot to go up to 40,000 feet and go into a straight dive, and I never told him to pull out. And normally, you know, that is courage. Finally, at the last minute, I gave him the command to pull out. He turned around to the other generals and admirals there and said, that, gentlemen, is courage. Well, the the Navy admiral had to get up and say, listen, we got new subs that are out, and they can go as far down without cracking and pressurizing than you would believe. So I sent my submariners into the Marianas Fault, which is one of the deepest, ocean beds around, and even those subs, how as well built as they are, can't go down that far without busting apart. So the sub's going down. He's talking to the other generals about it squeaking and starting. The bolts are coming out, and he finally tells them to pull up, and he says, that, I think, is courage. Well, finally, the Army general gets up, and he tells a guy from the 82nd Airborne and a Ranger, hey, I want you to go up. I want you to jump out of that plane without a parachute. And the Ranger and paratrooper looked at him and said, General, you can go to hell. General turned around to the other generals and admirals and said, now that, gentlemen, is courage. Well, I can tell you, you're all courageous, because if you're investors and interested in this, you have to have courage to go through this market that we've been through for the last 10 years, or longer, you went through the Great Depression. So some of this, I'm going to talk about that today. Okay, let me get my water. I was gabbing with everybody out there in the Ball Stars. I'm parched. Okay. So I'm going to have some prepared remarks for you tonight, about 30 minutes, and then I'm going to take your question and hopefully I'll have some answers. On your questions, anything's fair game, so don't be shy. I know some of my clients are here, and I'm pretty sure they won't be. The market continues to be resilient due to healthy U.S. fundamentals and the expanding economy. This has pushed the stock market up about 150% since its March 2009 lows, reaching new record highs during 2013. You may be asking, what is next for the stock market? Of course, no one knows what stocks will do during the short term, but we believe positive fundamentals support the long-term trend of higher stock prices. Despite record high stock prices, many investors are constantly reminded of obstacles in their path. Tonight we'll examine the United States debt and deficit, the economy, inflation, interest rates, international investing, to include those pesky emerging markets we've heard so much about lately, and also investing in today's United States stock market. It's impossible to predict the future, but today I'll share information and data about several positive trends to help put concerns into perspective. Let's start by addressing the debt and deficit concerns. The U.S. government has run a budget deficit for most of its history. Deficits aren't new, but the current size is larger than past deficits and is not sustainable. Politicians have had difficulty agreeing on ways to cut large deficits. Although the strengthening economy has helped the situation by increasing tax revenues, some difficult decisions have been made, but additional changes are needed. In other words, addressing the growing U.S. debt is a long-term issue. Revenues from taxes cover 81% of what the government spends, and the rest must be borrowed. That's the deficit. When we look at what the government spends, unfunded entitlement programs such as Social Security, Medicare, and Medicaid are a source of long-term spending pressure, and little has been done to address these issues. Together, these spending programs and other programs classified as mandatory made up more than half, or 58%, of federal spending during 2013, and to increase and continue to increase as a percentage of total spending. Many people depend on these programs, but there's no denying the issues associated with their long-term funding and the impact of that funding on the overall debt. These decisions will require modest but painful actions, and this may include benefit cuts and higher taxes in the future. We don't know how these decisions will turn out, but Congress has already identified and I want to specify identified, trillions in deficit reduction over the next 10 years. This chart shows that the U.S. federal budget deficit has been declining for the past 4 or 5 years. 4 years ago, the deficit was more than $1 trillion. It dropped to $650 billion in 2013, or 4% of gross domestic product. This was a result of spending cuts and higher revenue due to tax increases in the improving economy. Although it's still large, the smaller deficit is likely to get less attention in Washington. Political debates about how to address the long-term deficit issues will likely rage on for years. While government spending has been declining in recent years, additional cuts are likely. Also, tax increases on high-income households went into effect in 2013, and we believe more investors will see tax increases in the years ahead. However, it's important to understand that your financial choices are likely to make a bigger impact on your long-term financial goals than anything else that results from the deficit debate. As a result, we believe you can prepare today by reviewing your portfolio and taking some actionable steps. One way to address this uncertainty is to evaluate the tax diversification of your investments. Tax diversification refers to investing in accounts with differing tax treatments. Consider funding tax-deferred investments such as IRAs, 401ks, and educational savings plans to the contribution limit. Contribute to Roth IRA or Roth-like accounts under an employer-sponsored plan. Include tax-advantaged municipal bonds in your portfolio, and then purchase dividend-paying stocks with the potential for dividend increases to beat inflation. You can't control what will happen with government policies, but you can control the quality and types of investments you own and how they combine to form a portfolio tailored to your particular circumstances and goals. You might expect that policy uncertainty would be a negative for the economy. However, the U.S. economy continues to grow at a moderate pace, even amongst all the uncertainty we've had the past couple years. The economy has grown at an annual rate of 2% during the past 4 years. We expect that fewer roadblocks for United States economic growth will mean that the pace will pick up slightly to 2.5% in 2014. In addition, the International Monetary Fund expects global economic growth to accelerate to 3.6% in 2014, up from less than 3% during the past year. Faster global growth can provide a boost to the United States stock market. The U.S. economy continues to grow because consumers' financial situations are healthier, supported by low interest rates. Consumers are continuing to spend money as they slowly regain confidence, and businesses are continuing to invest some of their record cash levels. While we think a U.S. recession in the near future is unlikely, be aware that periods of slower growth could prompt headlines about recession concerns. Despite constant worries, we believe the overall U.S. economy is strong enough to sustain modest growth. A growing economy sets the stage for good investment results, but it certainly doesn't guarantee them. Modest economic growth has meant tepid job growth, which we believe will continue. However, it's important to keep in mind that the unemployment rate doesn't drive the stock market. We expect 2014 to be the 5th consecutive year of steady job growth. More than 7 million jobs have been added over the past 4 years, according to recent employment statistics. This is encouraging, but it has been a slow path toward recovering the nearly 9 million jobs lost during the recession. This recent job growth has caused a decline in the unemployment rate, but the rate still remains at stubbornly high levels. This chart is one of my favorites. The gray line actually shows the recession periods for the past 70 years. The blue line actually shows the amount of unemployment prior, during, and after the recession. The chart shows it can take quite a while for unemployment to shrink after a recession ends. This lag in the jobless rate is typical. Employers usually need to experience prolonged improvement in the economy before they start to hire new workers. After peaking at 10% in late 2009, the unemployment rate fell to about 7% at the end of 2013, still above historical averages. Overall, the jobs recovery remains intact. An old proverb states, "Slow and steady wins the race." As frustrating as it may be today, the slow, steady improvement in the labor markets and the broader implications for future economic growth suggest that backing the tortoise may not be such a bad strategy. Inflation and interest rates. Low inflation and high unemployment have caused the Federal Reserve to keep interest rates low in an effort to spur economic growth. However, low interest rates may be creating a headache for investors who are trying to reach their long-term goals. The yield on short-term treasuries, as measured by the 2-year Treasury yield in this chart, is well below the current inflation rate. This means your interest rates on 1-year, 2-year, and less CDs, they're not keeping pace with inflation. With interest rates at historic lows, higher yields on long-term bonds may tempt investors looking for income to add more long-term bonds to their portfolios. In some cases, investors may have too much in bonds or too much in long-term bonds. In the summer of 2013, long-term interest rates rose more than 1%. That was the fastest increase in decades. No one can predict how interest rates will move, but we believe rates will bounce up and down as investors anticipate higher rates in the future. We believe short-term rates will likely remain low for several years. However, long-term rates are determined by the market's expectations of economic growth, inflation, and other factors. Given our outlook for continued economic improvement, long-term rates could keep moving higher. Rising rates eliminate a tailwind that has helped bonds for more than 30 years. You may need to make changes to ensure you don't have too much invested in long-term bonds. When interest rates rise, bond prices fall. On average, long-term bond prices fall more than short-term bond prices. For example, a 1% increase in interest rates might reduce the price of a 5-year bond today by about 4%. But the price of a 30-year bond might fall by 14%. Long-term bond prices are far more sensitive to changes in interest rates. With those double-digit numbers, those are more like stock price fluctuations than bond price fluctuations. Keep in mind, however, that if you own individual bonds, you will still receive the same interest payments as well as the full value of your principal when your bond matures, assuming it doesn't default. Your focus shouldn't really be on the price fluctuations unless you sell your bonds or you need to sell your bonds prior to maturity. Even so, changing interest rates and fluctuating bond prices can seem quite unsettling. Again, it's impossible to accurately predict what interest rates will do and when. That's why it's essential to ladder bonds. Laddering means owning bonds with varying maturities. This strategy can help increase the likelihood of more stable and predictable income over time. In our view, short-term and intermediate-term bonds offer a better trade-off between income today and the possible impact of rising interest rates in the future. That's why we recommend long-term bonds represent no more than 25% of your fixed income portfolio. not your total portfolio. If you're seeking ways to generate investment income, you may want to consider owning stocks with the potential to increase your dividends. Owning equities involves different risks, including day-to-day volatility. Since stock prices will fluctuate, you may lose money if you sell when the market's down. That's why we recommend a balanced portfolio, including both equities and fixed income investments. Consider the historical performance of well-diversified portfolios consisting of 65% invested in stocks and 35% invested in bonds. Though past performance doesn't guarantee future results, this type of portfolio hasn't historically had a negative 5-year return if dividends were reinvested and the portfolio was rebalanced annually. In fact, the lowest 5-year return was more than 1% per year during the Great Recession of 2008. With volatile markets and a world of uncertainty, it's understandable that you may be anxious about stocks. But remember, investing success rarely results from doing what's comfortable. Instead, it's typically the result of doing what's uncomfortable but sensible. Let me say that again because I think it's one of the most powerful statements in tonight's presentation. Remember, investing success rarely results from doing what's comfortable. Instead, it's typically the result of doing what's uncomfortable but sensible. Long-term investors need to be aware of the risk of investments not keeping pace with inflation. Dividend-paying stocks can provide the potential for rising income, which can help offset rising prices. From 1947 to 2012, dividends paid by the S&P 500 companies rose an average of 5.9% per year. This outpaced inflation for the same period, which averaged 3.7% per year. Keep in mind, though, dividends can be increased, decreased, or eliminated at any point without notice. Let's turn our attention now to what's happening outside our borders. Slowdowns in China and Japan, as well as recessions across Europe, dampened global economic growth during 2012. However, the global economy started to improve in 2013, and we believe it will continue into 2014. In fact, after a year and a half, Europe recently emerged from recession. We believe improvement in the global economy may present an opportunity for investors. If appropriate for your investment goals, we recommend that long-term investors allocate up to 35% of their portfolios to international investments, primarily in equities. International equities have generally tended to rise and fall at different times than the United States stocks, which can help improve overall portfolio risk over time. There are other reasons to consider adding international investments to your portfolio. First, there's diversification. 15 to 20 years ago, the United States accounted for 70% of market capitalization. Now the United States accounts for a little less than half of the world's stocks. The other half includes many countries with stronger growth, which is measured by real gross domestic product. We believe investors can benefit from owning companies based in other countries because they add greater diversification to your portfolio. This offers more exposure to different economic cycles, interest rates, and currency environments. Second, we believe international stocks are currently attractively valued. We believe foreign equities remain attractive because they offer a higher dividend yield and higher expected earnings growth. Also, the values of foreign stocks are attractively priced when compared to their earnings. This indicates their fundamentals remain attractive. Third, outperformance historically follows underperformance. Foreign equities, as measured by the World Index, excluding the United States, underperformed United States stocks during 2010, 2011, and 2013. Because prices of foreign stocks have lagged behind, they could be good additions now. Also, you may need to rebalance your portfolio to their target international allocation. Of course, all investments carry some sort of risk. With foreign investments, you may be exposed to currency fluctuations. Possible economic or political events also could impact performance. Remember that your international investment should be spread broadly across the world's equity markets, not concentrated in any specific country or region. We believe the improving economies in the rest of the world have created an opportunity to add international equities at attractive prices. I've included a copy of our report, International Investing, A World of Opportunity, in your packet today. If you have any questions about the information in the report, I'd be happy to speak with you after our meeting. Let's talk about the United States stock market. It's certainly seen a lot of ups and downs over the past few years. It actually is a normal part of investing. It took more than 5 years, but in March of 2013, the Dow surpassed its previous record high reached in October of 2007. The path to new highs has been a long one, and the rise has been impressive. The market is up about 150% from its low in March of 2009. The S&P, a broader measure of the stock market, also reached its all-time record high. The stock market's gains in recent years are reassuring news for investors, especially those who worried that stock prices would stay low for a long time. Now, some investors are concerned that stocks might falter after reaching new highs, but that's not what history shows. In fact, stocks have typically continued to reach new highs. Since 1954, when the S&P 500 rebounded to its prior peak after a bear market, it has continued to rise by an average of 40% during the next 21 months that followed. Now, you probably don't know, judging by the headlines and Dow reports the past couple of days, that stocks don't go straight up. The past 2 years have been abnormally calm, as the market did not record a 10% correction in 2012 or 2013. But it's important to note that it's typical to see a dip in the stock market of 5% or more 3 to 4 times a year. Corrections of 10 to 20% one time a year. In bear markets, to include recessions, of 20% or more every 4 years. We never know when these pullbacks will occur, but we know they're frequent, and long-term investors will experience many of them. Despite these numerous pullbacks along the way, the Dow has had an average annual return of 9.7% since 1900, and that includes dividends. You may be worried, though, about the next bear market. Let's look at a hypothetical example from the last bear market. It's actually the last time the market peaked before the 2008 Great Recession. In October of 2007, the last time the stock market reached an all-time high, 3 investors each decided to invest $10,000. Since most people don't own just stocks, they each invested 65% in stocks and 35% in bonds. Now, the red line represents Nervous Nelly. Nervous Nelly watched the stock market hit bottom in March of 2009 and decided to flee to cash. At the end of June, her portfolio was worth $6,460. The blue line represents Cautious Carl. Now, Cautious Carl also moved to cash when the market bottomed, but he decided to reinvest a year later when things seemed a little better. At the end of June, his portfolio was worth a little more than $9,590. The green line represents Tenacious Tracy. Now, if you notice something here, I'm smart because the ladies are outperforming the men in this slide. So, Tenacious Tracy, on the other hand, decided to weather the storm. She stayed invested. She rebalanced annually. Her portfolio rebounded above the initial $10,000 mark in late 2010 and showed a healthy gain. Her portfolio was worth more than $13,520 by the end of June. It's important to understand your level of comfort with risk. This will help you better control your emotions and stick to your long-term strategy during the inevitable uncertainty along the way. Remember, it's also important to remain focused on your long-term financial goals. Really, that's what you're saving and protecting this money for. You want to make sure you have money for retirement income or retirement savings or estate planning, family foundation planning, educational planning. What's really important is to focus on the long term, on what your goals are, and the quality and mix of your investments, and your reactions to surprises along the way. And that's a really big one. I'm going to say that again because I constantly try to make investors aware, if this happens, what will you feel? And you really don't know until you go through it. So it's really important to understand your reactions to surprises along the way when you're building your portfolio. Lower stock market volatility over the past few years has caused investors to feel better about the markets. As investors feel more confident, they've added stocks to their portfolios. After rushing into bonds and reducing their equity holdings during the past 5 years, investors added more than $20 billion into equity funds in the first 10 months of 2013. We believe investors will continue buying stocks in 2014 as confidence rebounds further. Consider moving before the crowd and adding equities to your portfolio. In the past, the favorable cycle of portfolio shifts into stocks continued to reinforce each other for several years, as illustrated in this chart. Although we think the fundamentals support rising stock prices, we also think investors need to be much more selective. There are many ways to judge whether stocks are expensive or inexpensive today. Most of them show that stocks are near their average. They're not expensive, but certainly they're not priced the way they were a couple of years ago. That's why we think it's important to search for value. Company fundamentals are starting to play a bigger role in differentiating stock performance. While it may not be easy to find value in today's markets, we believe that you can find attractive investments to add to your portfolio. As a part of your packet today, I've included the quest for value, which may help shed some light on this subject. In that handout, the quest for value, we explore 3 paths to getting value and uncovering value in today's market. First, stocks that are out of favor. Secondly, stocks with catalysts that may improve performance. And third, companies that have been performing well and still appear attractive. You may want to consider adding these types of investments to your portfolio if they are appropriate for your situation. While we do see an opportunity to find value in the current market, it is important to discuss and prepare for the potential market volatility. Typically, what prevents many investors from reaching their goals is not market volatility itself, but reaction to the volatility. When the road gets rocky, your first thought might be to find a smoother route, also known as going to cash. But this might actually cause you to veer off course. According to a study by Dalbar was founded in 1976. It's a Boston-based investment research firm. The average investor's portfolio provided only half the return of a portfolio that followed a buy, hold, and quarterly rebalance strategy. That's not because the average investor owned the wrong investments. The reason is that these investors chased performance, buying when investments were up and selling when investments dropped in value. Keep in mind that investing involves risk. Your principal and investment return will fluctuate, and you may lose money if you sell when the market's down. Let's briefly review the concerns we examined today and highlight the strategies for addressing them. Deficits and debts. High deficits and debt are long-term problems, but they shouldn't prevent you from making appropriate investment decisions now. Historically, the stock and bond markets have paid little attention to the size of the federal deficit. You can't control what will happen with regard to government policies, but you can control the quality and types of investments you own. The economy. We expect modest but sustained economic growth to continue. Remember that the unemployment rate doesn't drive the stock market over the long run. Inflation and interest rates. Low inflation and high unemployment have kept interest rates low. These low rates can make it difficult to reach long-term goals. Laddering bond maturities and seeking dividend-paying stocks are two strategies that can help your investments outpace inflation while reducing sensitivity to interest rate change. International investing. We view international stocks favorably. They have underperformed during recent years, and we believe they are poised to outperform United States stocks over the next few years. Higher dividend yields and earnings growth from international investments should provide favorable trade-offs for elevated international risks. The stock market. In general, we're optimistic about the future of the United States stock market, but we know there will be several setbacks to reaching your long-term goals. Focus on value and time-tested principles, which we believe will better prepare you for reaching your goals. I hope I've addressed your concerns relating to the economy and the financial markets. At this time, I'd like to open the floor for your questions. Yes?
Mr. Carlin, I've noticed that the mortgage rates have increased recently, and because of that, I wondered what you believe might be the prospects for the U.S. housing market in the near term and long term.
Yeah, that's a great question. Yes, the question is, mortgage rates recently have gone up, and we had a little more of a housing market momentum, and it's kind of cooled off recently because of the rates going up. What's the prognosis for the real estate market? So, first thing is, I can tell you, I feel strong about the real estate market to have modest growth. A couple reasons why. When those mortgage rates went up, they actually went down again. They're actually down from that little spike they had. And those mortgage rates will be more influenced on the short-term rates that we currently have, and those short-term rates should last for another 2 years. We believe that the 2-year Treasury bond will stay near 0.25 for a lot longer than what we currently have, some of what the articles you're reading about. The other reason, though, is inventory has been whittled down. I actually have done a little due diligence and gone out with a real estate agent that I highly respect, and have kind of looked at what types of homes are out there and how many really are out there. And there's really not a lot available, so a lot of the excess inventory has been whittled down. The other reason why I don't think the housing market will explode but will be modest growth is you have to replace a certain number of houses every year. There's earthquakes, there's condemnation of homes, there's homes that get washed away by floods, so there has to be a certain amount of homes that are rebuilt. So that's another reason why. The other reason is, look at all the rental properties that have gone up throughout the city. Well, that's because there was an overabundance of single-family homes and not a lot of rental property. It's kind of like a teeter-totter. It goes back and forth. And now that rental rates are going back up, it's becoming almost more affordable, or certainly is more affordable now, to actually own rather than rent. And it goes back and forth. The last thing I'll address is hormones. One of the reasons I'm real bullish on the United States long-term is heat, hot rods, and hormones. So let me explain. And hormones relates to homes. Heat. Heat is the fracking that we found in North Dakota, South Dakota, the ability to become a net exporter, 20 million barrels a day. That is a huge thing that we're going to be able to do over the next couple of decades, which will allow us to de-link from the Middle East. So that's the first reason. The second reason, hot rods. We were driving our cars around for 10 years, and then it became more expensive to fix it than to buy a new one at 0 interest rate. And you know that's a fact because you've seen the reports about GM and different car companies doing quite well. Then hormones. Hormones relates to home. Do you realize that of kids 26 to 37, there's about 33% that are living with their parents? 33% of kids like 26 to 37, I didn't even know you were a kid still at 37, are living with their parents. Well, that's where hormones comes in. There's only so long you can live with your parent, with your girlfriend, when at some point you want to get out and buy your own home. So when you start adding all that up, the housing market isn't going to be robust like it was prior to the Great Recession, but it will continue to do its job and support the economy. Great question, thank you. Yes, Dennis.
During the recession of 2008, government bonds were one of the better performing investments. What's your outlook for 2014 and perhaps 15?
Okay, now we get into our little packet. So, Dennis is referring to how government bonds performed. You know, in 2008, it seemed like everything went down, but it really didn't, not everything. So, pull this little, it's called The Importance of Fixed Income Diversification. The question was, how will government bonds perform 2014? Now, I don't quite know the exact answer to that, but I can certainly give you some trend information. And then you guys are smart enough, you could probably look and see and figure that out. So let me first, as everyone grab this out, I want to talk about what bonds do when interest rates rise. Because we're in a rising interest rate environment. So let's go through that. So if you look on the chart, on the bottom left-hand side, the federal funds target rate. On the lower left-hand side, you can see the federal funds target rate. So that's the Fed funds rate. Currently, it's at 0.25. So if you go to 1993, it was 3%, and then it went to 5.5%. Okay? Everyone see that? So that's 2.5% rise in interest rate. So that seems pretty reasonable that could happen currently in the United States under our current conditions. So when you look at the bonds, there's all different types of bonds. So in 1994, there's floating rate bonds, there's international bonds, there's global bonds, there's short-term government bonds, there's asset-backed security bonds, those are like mortgage bonds, there's global bonds. So you can go right on down the list and see what happens. There's the 10-year U.S. Treasury bond. So this is a great way to understand in a rising interest rates, what do government bonds do? And bonds act one of two ways. They're either interest rate sensitive or they're credit sensitive. Interest rate sensitive bonds have a tough time in rising interest rate environments. Credit-sensitive bonds have a tough time in bad economy, like 2008. They act different. So the one thing I want you to get out of tonight is not all bonds act the same way. They act different, and you need to own different types of bonds to have the right type of diversification, because if you have only one type of bond, you're setting yourself up for failure. Let's go to another rising interest rate environment. Let's go to 2004 to 2005 to 2006. So we went from 2.25% to 5.25 over 2 years. There's another example of how you can look and see what bonds do. And then one final area to look at, if you go again to 1998 to 1999 and then 2000, again, you have a good 2% increase. And that seems certainly reasonable in the current conditions we're in. So that's a really interesting chart for you to take back and look. And it's really important when you go back home just to look at your portfolios and see what amount of bonds you have. What type are they? Are they just all one type? Should they be different, especially in a rising interest rate environment? Great question. Thank you. Yes, ma'am.
Last night, the president mentioned my bonds. What kind of bonds do you think you would have?
Well, it was my bonds? I think he made a mistake. Yeah, I think he made a mistake. I think he was, like me up here, tongue-tied at one point, and it rumbled together. I think he was referencing my IRA. Yeah. I think it was just a mispronunciation. Yeah. Great. Yes, Jerry.
On your chart, several of the examples you just talked about, international bonds were the best. So I have an international question. In 2014, is China the best place to invest? And if so, how will it impact my investments?
Okay, that's a great question. Before I get to that question, I want to have a little fun with you guys on the international side, because a lot of times people are they're a little put off by international sometimes, and sometimes they have too much in international. So, anyone who wants to play this game, I've got a little prize at the end of it. The question is China the place to invest in 2014? And before I answer that question, I want to see how well you know what companies are from what country. So, if anyone who wants to play, stand up, and then if you get the right answer, you stay standing, and we're going to be on our honor now. So whoever wants to play, stand up. I've got a great book to give you if you win. Okay, thank you, sir. Come on, I know. Now, my clients shouldn't do this because they've been through this already. All right. All right, so here we go. Come on, a couple more people. That's it. Thank you. So you'll probably win. All righty. So, on your honor, here we go. Braun household appliances, they're the shavers and different coffee makers. Are they Swiss, German, American, or Japanese? German. Okay. If you said American, stay standing. Let me go to number 2. This is going to be very interesting. Is there anyone standing? All right, you're still in the game. No one got it right. Everyone stand up still. All right, next one. Bic pens. Japanese, Czech, American, or French? All right. If you said French, stay standing. All right, we got a couple still remaining. Very good. The maker of Haagen-Dazs ice cream is based in France, Sweden, Britain, or America. If you said Britain, stay standing. All right? You guys get back up. You got it all wrong. We still keep going here. Okay. Sometimes what you think is international isn't, and sometimes it is. But these are great companies. Would you agree? Yeah. I never could figure out why people don't like international. RCA televisions are made by a company based in Japan, America, France, or Korea. If you said France, stay standing. All right, you guys can keep standing up. That's good. That's good. All right, you're still in the game. All right, now you guys got to get this one. The men have got to get this one. I mean, we're talking about shirts here. The parent company of Aero Shirts. Aero Shirts. I've got one on tonight. Thai, Italian, American, or French? If you said French, stay standing. Yeah, you guys are still in the game. No problem. We'll get it eventually. Now, the ladies, do we have any not still, darn. Godiva chocolate, French, Belgian, Swiss, or American? If you said American, stay standing. All right, well, come back up. You're still in. We have 3 people in this game here. Vaseline. Vaseline. How many people use Vaseline at some point in their lives? Certainly. Vaseline's owner is American, French, Anglo-Dutch, or German? If you said Anglo-Dutch, stay standing. All right, very good. We're down to 2. We're down to 2. All right. How many people drive a car here? Okay. Firestone tires are made in Japan, America, Germany, or France. If you guys said Japan, stay standing. All right, we still have you in the game. You're both still in. You're both still in. Holiday Inns are owned by a company. Holiday Inn. France, America, Britain, or Saudi Arabia? If you said Britain, stay standing. We have a winner. Congratulations. And you, sir, get the China book. So, Jim, if you could run it up there to that gentleman. It's a wonderful book. It really talks about the coming Cool War with China. You'll really enjoy it. So, do we invest in China? China, a couple good things about China. China buys our bonds. China buys some of our products. China is actually running on a capitalist economy under a communist dictatorship, which is very interesting. The other thing that China does is it actually provides some stability with the Islamists that they're fighting in that part of the world, because they also have a problem. But you don't want to buy or put all of your international investments in China, because what you want to do is not buy a country because of the political upheaval. They normally go through an upheaval every 500 years that is just dramatically amazing. And that's what they're trying to avoid right now. So in China, they're trying to modernize the interior of the country. The exterior is in good shape. The coasts are in very good shape. They're very modern. If you go there, you think you're in a North American city. The problem is in the interior, and they have to keep creating jobs for those folks that they're bringing into the cities. And it's like what we did around the turn of the century when we became an industrial power and we changed from an agrarian power. The other reason, though, that you don't necessarily want to totally invest in China, in your packet, I gave you international investments by country. And if you pull that out, it looks like a little jelly bean chart. And on one side, it has the best performing countries over the last 10 years. And on the other side, it has the best performing regions. So who would have thought, with all the problems Europe was having, that Germany in 2012 would have returned 32%? And then, if you were right about China, I think they have 1 year, or Brazil in 2003, they returned 115%. The problem with that, though, is when you look and follow that little color, you can see that there's wide swings where they're up 1 year by 70 and down by 70. And that's not how you want to invest. You really want to invest in good quality companies that we were talking about here tonight that might be in those countries, but you don't want to specifically invest in just one country. Yeah. Yes, sir.
Is there a difference in an international fund and a global fund?
Yeah, that's a great question. The question is there a difference between an international fund and a global fund? And an international fund is generally without the United States. A global fund is with the United States in it. Yes. Yeah, global includes the United States. International is without the United States. Yes, sir.
You touched on this, and I was glad that you mentioned about it. And two questions. One, I'm referring to the heat aspect that you talked about. In my opinion, the country was built on cheap energy and cheap labor, my opinion, and innovation, of course. Now with the shale, and now they're talking about getting gas from the icebergs or something. Okay, so when we export, then, and when we export this energy, then we are no longer contributing to OPEC. And so then I see our deficit coming down because, and then also with the deficit, a lot of it is to ourselves. So when we contribute money to Social Security or food stamps or whatever, I mean, or people concerned about deficit, Americans are spending that money here and not spending it somewhere else. So, So my question is then, from the standpoint, if that's an accurate scenario, then do you see that deficit coming down more, where then the country's going to decrease? And then the second question you can briefly ask, where does gold fit in the metal itself now?
Let me take the first one. Yeah, the second one's easier than the first one, but I'm gonna answer them both. So the first question I'm gonna answer, where does gold fit in your portfolio? And I believe every portfolio should have commodities in it. You should have no more than 10 and probably 5% to include gold, palladium, silver, corn, feedstock, cattle, all the things that make up commodities. That's very important to diversify your portfolio. So I agree that commodities should be a part of your portfolio, no question about it. Now, the second question, which is more difficult, is with the fracking and the expected growth with our energy production, will that help us grow out of the debt and deficit? Great question. So there's two different ways that you can help your debt and deficit. You can grow out of it, or you can help reduce costs that you're spending. And with the fracking and the heat, the energy, that is going to be a huge thing for a couple reasons. There's second and third order effects. When you take the fact that we don't need to import or export oil or necessarily protect the Strait of Hormuz and get involved in the Middle East, we're going to deleverage out of the Middle East, which we know we're doing that. And that's going to pay a little bit of a dividend from the standpoint you have a little bit of a defense dividend. Now, we're going to re-leverage in Asia, because that's our new focal point. But that's one area that we're going to let Iran and Saudi Arabia handle and kind of extricate ourselves from the situation. One of the benefits of having different cultures is that sometimes they don't agree. So in the case of the Islamic culture, it used to be, we had a strongman in Iraq, which kind of was a buffer against Iran. And now what we have is a Sunni, which are Saudi-backed, the Islamic faith. You know, there's different branches, just like Christian. You've got Lutheran and Presbyterian and Methodist and Catholic. You've got a Sunni, which are Saudi Arabia-backed. That's proxy in Syria, and they're fighting Iran, Shia, in Syria. Now, I'm simplifying things here a little bit, but my point going back to heat is, we're going to see in the Middle East, Shia and Sunni, that'll be Saudi Arabia and Iran, vying for strategic influence there and kind of creating a buffer to create some semblance of order, if you can call it that, over time. That allows us to move out, focus on Asia and China, and then it also allows us to focus more at home. I think the XL pipeline will get approved. There will be tremendous jobs with that. There'll be tremendous different applications off of the oil that we're going to have. I think the technology that we're going to develop from easy access is going to be tremendous. Manufacturing will be cheaper because we have more energy here. The rule of law is another reason I'm so high on the United States as far as people wanting to do business here. And then the labor force is retraining. I mean, we do have low unemployment, but did you see how packed the parking lot is? Because everyone, whether they're 40, 50, 60, 30, 20, going back to school, getting into a different career path, because some careers close, some careers open up. So it's very key. So yes, I think that's going to definitely help us out of the debt and deficit. I think we'll have to do some work, though, on the entitlement piece, only because the demographics aren't in our favor. When that first was set up, that was set up in 1930s. Prior to 1930, when you had a recession, you were wiped out. You were on the soup line, you lost your home, you lost your business, there was no FDIC insurance, the banks were gone. So we implemented FDIC insurance, we implemented unemployment, we started Social Security, we started Medicare. Well, back then, people retired at 65 and they passed away a year or two later. Now people retire at 55 and they live till 95. So that it's not a political, it wasn't caused by a political party, but it's an issue that we have to also address along with growing our way out of the debt and deficit. So it's going to take a combination of both, but I agree with you. I think real strong. I mean, that's what a tremendous win. And you know why we found that? Because of the technological development here. The way to get oil horizontally instead of just vertically. It wasn't invented in China. It wasn't invented in Japan. It was invented here. And that's the strength of America. Yes, sir.
Hitchhiking on your last point there about exporting energy, what do you think about the Keystone Pipeline and helping our neighbor Canada, perhaps helping us extricate ourselves from the Middle East?
I agree. I mean, personally, I agree with it. I think it's only a matter of time until we do that, because our national security, and one of the reasons I like my background as a military officer is I can bring that to play in geopolitical strategy as it relates to investments and what's happening. When you look at the world, the United States, Canada, and Mexico, even with their problems, are natural allies. We're all Christian. There's all a degree of law. I know we hear the headlines about the drug lords and such, but really, you can go down to Mexico and generally speaking, have a safe time. Well, more and more what we're doing is that pipeline and energy and goods flowing back and forth, we're merging. It's important we do that because as China gains strength, as the Middle East is in turmoil, as Russia reemerges, although they're only a one-trick pony with energy, it's important that we use our synergistic effect with Canada, Mexico, and the United States. And I believe more and more there'll be more and more cooperation and integration between all three countries to include that pipeline. Yeah.
Okay. Add on point. I read an editorial yesterday, and many of you saw it, where if we don't make a favorable decision toward that pipeline, the pipeline's going to be laid anyway, and the oil's going to go to China.
Yeah.
Now, does that help, hurt?
Well, it's going to hurt if that happens, but I don't think that's not. I think the pipeline will be a part of a bigger deal working through Medicare and Social Security. See, to get that deal done, there's going to be a lot of give and take. And anyone see Lincoln? God, that should be mandatory viewing by everyone because that was such a great movie. I went to see it like 2 or 3 times. I think I saw it 3 times, but it's great because you saw how deals get done. And that's what's going to get done. And that's how that deal's going to get done. Because everyone knows it. We all know we have to grow our way out and we have to kind of redo our system. Let me say this. Everyone put your history cap back on. This country goes through a major transformation every 80 to 100 years. You guys are not special. This has happened before. Let's go back. So Plymouth Rock is founded around 1650, give or take, 1660. And then what happens 80 to 100 years later? War of Independence. War against the British. Okay, so 1776. 80 to 100 years later, the Civil War. Now we think we're in such an upheaval time, it's so bad. We're kind of like high school kids. When we get elected prom king and queen, we're on top of the world and we think we're invincible. And then we get a bad grade or something happens, it's like the world is falling in. I mean, America is that way because we don't have the history that other countries have. This country got through the Civil War when we had millions of unemployed people that were just freed walking the country. And we came out of it okay. I can assure you we will come out of the transition with the unemployment, Medicare, Medicaid, fine. But let me keep going, though. So we had the Civil War. 80 to 100 years later, what happened? World War II, New Deal, Medicare, Medicaid, all the different things came into place to help protect us. Big transition. Soup lines, big transition. World War, different parties in power. I mean, if you look through history, parties have risen and fallen. I mean, Whig and Tory aren't even around anymore. So it wouldn't surprise me if we have a different party at some point. It's a natural. It's what America does and goes through. And then last but not least, so we go through World War II, 80 to 100 years brings us to 2020. Okay, so we're in transition. It's not new. We've done it before. We'll do it again, and we'll come out a stronger country. Nothing's new today. We're just in transition. 80 to 100 years. Think back, think about it. It really makes sense. Yes? Yes, ma'am.
I'm really new to investing. So you're mentioning investing in international countries and specifically their companies. Is it just enough for a company to be like a household name for you to trust to invest?
A great question. I promise I did not plant all these questions. The question was, I'm new to investing. How do I know, good companies from bad? It's confusing to anybody. So, pull out this big chart. I love this little guide because it teaches so much. So, if you take out this ICA guide, and I want you to turn to page 4. Turn to page 4. Okay. This is really good. Page 4, it looks like this. Yeah. All righty. Now, when you look through those companies, if you have a pen, circle any one you've heard of or you use. And I think when you look through that, those are the companies that you're investing in. Those types of companies are S&P 500 companies. So back in 2008, we went through the Great Recession. I live right by Walmart. I shop at Walmart. I went into Walmart, and it's packed. It's packed. The parking lot's packed. People are in, and Walmart stock was it went from 70 to 35. But it's packed. That's why you buy Walmart, because it's on sale then. So many people don't realize that when the market fluctuates so much, it's not because the company's bad. None of these companies are bad companies. It's because there's two things that distort the market. Speculation, people that want to trade on good news or bad news, that distorts the market. Fear distorts the market. Fear, because people, let me rephrase that, fear and greed. People drive prices up too high, and then people drive prices down too low. So when everything's falling, that's not the fundamentals of what are going on. It's fear, greed, speculation that's in the market that's causing distortion. And that's why we kept referring tonight on long-term investing. If you need money for short-term, well, then we want to put it in cash or short-term CDs. So that's a part of investing, too. You don't put all your money in stocks. But there's nothing better than stocks, because if you open it up in those stocks that you just looked at, kind of pull this open real quick. This is kind of fun. So let's assume in the Great Recession, well, let's go back and, so if you open it up, and let's assume in 2001, you see where it says minus 4.6 on the bottom to the right? And if I told you, look, we have a tech bubble, we're going to have a crash, I want you to put in $804,000, and I want you to put it in the day before we have this crash, and in addition to that, we're going to have 9/11, and we're also going to have the Great Recession of 2008 with the improper mortgages, and at the end of it, you're going to have more money than when you first put in. If you knew all this stuff, would you do it? If I'm telling you the day before the crash. Well, if you did, in 2001, if you put $804,000 in, it's the line, 2 lines above, essentially you'd have $1.7 million, not counting 2013, from those companies that you invested in. So what happens is, through all the problem, if you buy good quality companies that you use every day, your phone, the shoes you buy, your gasoline you fill up, you're going to make good money over time. Yeah, just buy things you use and know and like, because that will always help you and keep you in good stead. Yeah, is that helpful? Okay, great. Yes, ma'am.
So, I mean, with all the pointers, and I teach personal finance here, I'm a professor here.
Welcome.
There's a lot of due diligence that an average investor must do in terms of keeping an eye on international equities, in terms of keeping track of the economy and so forth? What are some of the, we have all heard of diversification, but to my students, what are some of the key fundamentals that I must be conveying that they have to do? Because it seems overwhelming initially in terms of what are some of the key factors they have to keep in mind. I don't control the economy, I don't control international politics, I don't control the job market. So the young lady's question, what companies, that's a good rule of thumb. What are some others?
And I know you, first off, thank you very much for teaching our students about personal finance, because a lot of times it's never taught at all. And that's why, sometimes we're in the trouble we're in. So thank you very much. So when you look at where do you start when you're coming out or how to do personal finance, I think the very first thing that you have to make sure of is anything that's catastrophic is taken care of. And what I mean by that is when you're brand new out of school, if you have a family, it's really important you first get insurance to protect your family. That would be the first thing. And then it's important to get disability to protect if you lost your job. And then it's important to build up a 3 to 6 month cash. So if you got laid off, you had enough to survive. And I believe it's also important to have a will. So if you have young children, you get that in place and you have a plan and talk about. So I think once that's taken care of, if the student does nothing more than buy the S&P index and the international index and a bond index, and and again, I can't get too specific here, but if you buy based on their time frame in the right percentages, 40 years down the road, they're going to be a millionaire, provided they put money in every month, and when they get a raise, they increase it a little bit.
And that's what I try and convey, that the time value of money is the greatest factor, like Einstein had said. So I thank you for that.
It's not performance. So many people, well, what about performance changes every 3 years? Buy a good quality fund, index, stick with it through the long term, rebalance it as your needs change, don't touch it, and by the time you're 60, you'll have $1 million.
Maybe you can come back and give us ABCs of fundamentals.
Yeah, not a problem. But again, thank you for teaching, because that's a really big deal. Do you get a good turnout? Do a lot of people?
Oh, yeah.
Good, very good. Good. Thank you. Yes?
Could you address water rights and where that's heading?
That's a great question. I don't know much about it, and I apologize. The only thing I can say is water purification companies are extremely good quality investments because we're losing more and more of our fresh water. But beyond water rights, I apologize. I don't know. That's out of my area of expertise. Yes.
Where are we with the dollar being the world's reserve currency? Is that solid or?
Yeah, great question.
China keeps rattling about that, and some other countries also.
So where are we with the dollar being the world reserve currency? The dollar is right now here to stay. It will take China many years of structural reforms to be trusted as a country to have reserve currency. The state still owns their land. The state owns their businesses. I mean, it's just not conducive at this point in time to have them as the world currency. I think what China's really saying is, hey, look, we depend on you. We need you. You're the premier power. China knows that. Yes, China's a rising power, but we're the premier power. We need you to get your fiscal house in order. We need to have an agreement that provides growth with that pipeline and heat, and kind of restructures Medicare and Social Security to get you on a better path so we can be assured you're going to be there. And you're not going to have, see, my biggest worry is we have to make sure we get that agreement in the next couple of years, because if not, the demographics aren't in our favor, and that creates another crisis, which forces the dollar down, Treasury bond up, and we have a Greek-like situation. Not to that extent, but that's what China's trying to get us to do now. They're trying to get us, because they need to have a strong, stable United States in order for them to have a market to buy products to get them up to the 21st century. Yeah. Yes, sir.
Something you haven't mentioned in investing in, I realize it's kind of a mixture, mutual funds. How would you compare that as, instead of buying straight stocks, perhaps, diversifying using mutual funds or whatever?
Great question. Let's have fun. All right. What I want you to do is turn to page 5. I'm going to give you $1,000. I want you to pick 5 stocks out of those companies right now on page 5. So just X them and pick 5 companies. Okay, so take a minute, pick your 5 stocks. So knowing history, now you're going to get a chance to be a stock picker. Let's see how good you are. In this, the question is, mutual funds or stocks? All righty, so I gave you $1,000. You picked the 5 stocks. You held them through good years and bad years over 79 years. Turn the page and see what they made. You can turn the page and see the kind of what they made. So which one's the number 1 stock? Procter & Gamble, then ExxonMobil, General Electric, Coca-Cola, and McDonald's. So, adding them up, your investment came to about $1.8 million. But, if you did the mutual fund depicted in this guide, where you would move in and out of those stocks at appropriate times, you actually made $3.5 million. Because you take the 705 times 5, because that only represents $1,000 in that investment. So the key thing with mutual funds and what they offer, or a money manager, a professional money manager, they see fundamental and technical factors that they can move in and out of Apple. Apple's always a good quality company, but there might be better times to have it than not. And if you do that, you're able to actually, instead of just buying the S&P 500, if you get a good quality money manager, and there's a lot out there, they're able to kind of beat the average and actually outperform individual stocks. Yeah. Great question. Yeah, but that's a fun exercise. This book is so interesting from the standpoint, let's assume, I'm sorry, ma'am, yes.
When you're talking about buying good companies and holding them, I've noticed in a lot of mutual funds that the managers, they churn those because it isn't the thinking so much of buying and holding.
Yeah.
So they're constantly changing them.
Sometimes that's true. In more aggressive companies, there's all different types of mutual funds, because you have mutual funds that are bond mutual funds, you have real estate mutual funds, you have S&P 500 mutual funds, then you have aggressive mutual funds that are really small companies. Generally speaking, in the more aggressive types of mutual funds, I don't like to have any more than 5 to 10% of my clients' money there, because I don't want them to be disappointed. But they do a lot of, and it's not intentional, but they're looking for the highest return. So, yeah. Right, that's exactly right. In the aggressive growth mutual funds, that's the case. They're small companies, biotech, technology, water purification, 3D printing, things that are very new. So generally speaking, new investors should really stay away from that. Yeah. Yes?
Tim, I sure appreciate your financial acumen as well as your military strategic look at things, as well as your forecast about where things are going to go in the future. You talk about the demographic time bomb that we're looking at. Where do you see the role of immigration with all this?
I'm a believer in immigration because I think it's what makes our country great. I'm an immigrant from my family, previous generations. New ideas, new energy, hard work comes from immigration. So personally, I'm a big believer in immigration. I think ultimately there'll be a better handle on, how do we get into the country? What's the defined process for getting in? But I think immigration is what makes this country great. Yes, ma'am.
Back to the Medicare and Social Security. Do you have any ideas of how to solve that problem?
Yes. I'm glad you asked. Yes. So let me explain how this came to be. It's called the debt supercycle. So back when the economy would have bad years, 1909, 1918, 1897, things were wiped out. I mean, you're not talking about a 50% drop, you're talking 80% drop. So the government, they put stabilizers in during the time to avoid that. And what they did then, every time there was a recession, there's two ways they can control the recession: fiscal, monetarily. Fiscally, that's where the government spends money to build bridges, roads, schools, things of that nature. Our Autobahn system was based off Germany. Eisenhower built it, our highway system. So that's a part of fiscal spending. And then there's monetary spending, where the interest rates are reduced or raised to control inflation and now unemployment. So the government would have those levers. Consumers would do the same thing. They'd run up their credit card, they'd borrow home equity on their home. Well, over time, the excesses got more and more because the demographics didn't work, because you had more people retiring and less people working. So we had the big 2008 where the debt supercycle reached its limit with people, consumers. Consumers now are very afraid to run up debt. They don't run up their home. They want to pay their home off. Now it's the government that actually has done that, but it's not a political party issue. It's been going on since 1933 through both Democratic and Republican parties, and I could show you more detail on that one-on-one if you don't believe me. With that said, though, ultimately now there's going to be a crisis to get that fixed, and that's what I'm talking about when you've got to have revenue reform and entitlement reform. You've got to have both. So when you hear people talking, if you hear someone talking in a balanced fashion, in voting in a balanced fashion for both revenue reform and entitlement reform, it's going to take both to get it done, and it's going to affect all of us. It's going to affect military retirees. It's going to affect military pensions. It's going to affect your pension. It's going to affect Social Security, your kids' Social Security, and Medicare. We've all got to realize that to keep this thing going and come out of this 80, 100-year cycle the right way, we're going to have to make some sacrifices. Sir, you probably have seen a lot of this already way back in the day as far as the sacrifices that need to be made and getting through it, and it's going to affect us all. So to answer your question, we need revenue reform and entitlement reform, both. Maybe it's Social Security, you get it instead of 62, maybe it's 65 and full Social Security is at 70. Maybe Medicare is at 67, but it's got to be something on both sides. Maybe the home deduction, you only get 75% on your home mortgage deduction. It's got to be revenue reform and entitlement reform. And remember, entitlements aren't handouts, it's what we get. Medicare, Social Security, that type of thing. Okay, great question. Is that helpful as far as?
Yeah, I'm just wondering what the reforms might look like.
Well, I believe that Social Security will go up in age. I believe Medicare entitlement, if you make a certain wage or you have a certain pension or something, you're not going to get as much. You're not going to be covered as much. That's what I believe. I'm not saying that's fact. That's what I believe is going to end up happening. Yeah.
Well,
oh,
Tim, I'm sorry I have to cut us short. We're out of time, but your questions have been fabulous. Let's give Tim a round of applause.
Thank you.
And I should say, most of the blue card questions that I got were actually asked and answered during the session. However, if you did submit a question card and you don't feel like you got an answer, I think Tim would be happy to let you steal a few minutes with him out in the lobby, if I'm not mistaken. But I want to thank you all for coming. I hope that we see you on March 27th for our next event. I want to thank the Vol Stars for their great service. I want to thank the production crew, our video team, event management staff, and again, Tim, you prepared excellent information. I think everyone got a lot out of it. Thank you for your military service, and thank you for recognizing the service of our audience too. So thank you.